Ladies and gentlemen, good afternoon, depending on where you are. My name is Berggreen. I'm going to share some ideas that I am currently looking at. But first, let's peek into the recent market behavior. Okay, I'm going to see what's been going on. It's been some movements of volatility happening, and also some macro developments that's been going on recently. Now, as you're probably aware, the last few weeks have been pretty rough, okay, especially for the big tech companies and what we call the Magnificent Seven stocks. Now, these stocks are widely held by pretty much everybody, so yeah, it impacts a lot of people. Now, they all made new 52-week highs not too long ago, in the last few months, actually. So let's see where they are relative to that level. So Microsoft and Amazon both down close to 10%, Meta down 14%, Apple down 8%, Google down 13%, Nvidia and Tesla bringing up the rear down around 20% from their highs, from their 52-week highs, that is. So on average, these stocks are down 13% from their 52-week highs. And yeah, I know it's been a bit scary maybe for some people. But look, it really hasn't been that big of a deal. These price moves only bring most of these back to June levels. So you're just going to backspool a couple of months. And also, besides Tesla, most of them are up pretty massively year to date. Nvidia leading the pack up pretty much 130% for the year. So it really should not have been a big surprise to see pullback, okay, at these levels that they were at. Most areas of the market actually has done quite well for July. Now, the Russell 2000 had a bit of a pullback today, but it's up about 10% or so in the month of July. Financials and industrials also up 4-5% on the month. So it's just that the problem is that these big seven stocks have such a large overweighting, in most people's portfolios, and also mutual funds, so they tend to get all the spotlight. But this is something we've been talking about for a while within our community, that the steam is likely to come out of these, for a lot of these hyperscalers, as we're seeing a widening of market breadth, and capital really shifting into other areas of the market, specifically into more value-oriented names. In fact, the Vanguard Value ETF, VTV, is up 3.5% in the month of July, and really pushing into looks like could be new all-time highs here. And the Dow too looks pretty similar. And we are now in the middle of tech earnings releases. And it's not like these companies are not doing well. They're doing very well. It's just not enough to justify sky-high valuations. So before this episode airs, we're going to have earnings out from some heavy hitters, okay? So it's Apple, Microsoft, Amazon, Meta, and a couple of other ones are coming out the next, tomorrow and in the next couple of days. So the market picture could change quite rapidly. We'll see how it goes. Now, as far as the macro picture, let's just have a quick look at the most recent developments. I mean, we are constantly bombarded, with economical data. So it's going to focus on two most important elements right now, and also the most recent, that relates to growth and inflation. So one of the best gauges for current economic growth as a leading indicator is really the PMI data, okay, and specifically the S&P Global Composite Purchasing Managers Index. This survey is based on economical indicators and designed to provide timely insight into business conditions. And a figure above 50 indicates expansion, especially if it's climbing. And last week it came out at 55 for the month of July. If you look into the survey, it was a bit mixed. We did see a slowdown in manufacturing part of it, and some action picking up in the services portion, as I kind of not taking front seat. But the overall picture is still in pretty good shape if you look at just these metrics. There's been some shifts going on. Anyway, on the inflation front, One of my favorite things to look at is the PCE index. This is a Personal Consumption Expenditure Price Index. And it's something that the Fed watches closely, and obviously now we're all in kind of Fed mode. But that was a bit stronger for the month of July. But it's still way below 3%. It's going to stabilize below 3% on the year-over-year basis. So it's not really a big deal. All right, so let's have a look at some ideas that I'm looking at that might fit into this. Now, Alcoa is a kind of a mid-cap company, $6 billion market cap, the producer of aluminum and other metals. So with manufacturing slowing down, okay, and copper and other industrial metals weak, why am I looking at Alcoa here as a long? Yeah, and it could be a bit early, but the all-time high for the stock was set only 2 years ago, and it was close to $100. Now the stock is at 33, and the softer growth scenario is most likely already priced in here. Maybe not right here, but around these levels. Meaning there's a pretty good chance that this stock could rebound if the longer-term growth prospects look solid. Well, for the Q2 earnings release that was on July 17th, they actually beat EPS, earnings per share. They missed a bit on revenue. And there was also a production decrease of 5%. But that was expected, okay, due to the curtailment of the Kiwiana refinery. I'm not saying that right. But it's in Australia, and they are scaling this refinery back big time. So that's kind of baked into that cake. But the production forecast remains unchanged. Now, as usual, there's more going on under the hood that we have time to look at here. But looking at the increase in future EPS estimates, as well as a positive shift, really, in the consensus revenue, the trend here is actually pointing towards the upside. So I would say the future could be improving. For companies like this, with earnings per share going from negative to positive, you can't really use the normal PE valuation metric. It doesn't make sense. Okay, so we look at price to revenue or price to sales to get a more accurate measure of valuation in this case. And both trailing and forward-looking price to sales for Alcoa is just around a half. Okay, so it's just around 0.5. Now, to put that into perspective, the price to sales for S&P is close to 3. Now, Alcoa is clearly not a growth story. Okay, so this is not a company that usually carries high valuations, but if things improve, they will demand higher multiples going forward. And it was only 2 years ago, really, that the stock was around $100. I don't expect to see that level really anytime soon, but I think a rebound to about 40 to 45 could be realistic, okay, over the next few months. They report earnings on October 16th, so it makes sense here then to look at the October calls that expire a few days after earnings are released. So the 35 strike calls, when I wrote this up, are at 220. So you can buy them at 220. And that can be combined with a short leg, right? So selling the closer expiration, September, further out of the money. So 40 strike calls at 70 cents. And we do that to just harvest premium along the way and lower our cost basis as well. So if you buy 30 lots of this diagonal call spread, as it's called, it will cost $4,500. And that is also the max risk that you can lose on this trade. The stock was above 40 earlier this month, so it's not really asking too much, okay, for that level to get regained over the next month or so. Ideally, it will stay below 40 for the September expiration, allowing that to expire worthless, because that leaves us with a $2,100 credit. And at that point, the whole spread will be worth about $12,000 actually, which is decent. However, the plan is to hold this over the next earnings release. And by the time that happens, the short leg will be expired. And if the stock gets a good spike, gets to 45, this can be a 6-to-1 reward risk type of trade. The risk here is that the stock stays below 35, clearly. But in that case, we could potentially walk away mostly intact after harvesting the $2,100 credit. And there will still be time value left in the October calls. All right, so this is a clean and simple structure. So there's another candidate that I'm looking at, Lockheed Martin. I'm looking at this as a short play. Okay, you're all familiar with Lockheed Martin probably. It's a $125 billion defense contractor. Stock is trading at $525. Now, it's no wonder the stock has experienced a boost with what's going on the geopolitical front. But really, how long will that last? And they report numbers. Well, actually, I'm sorry, they reported numbers last week that looked pretty good on the surface. But cash flow is a bit of a problem. It's flat, so it's not very exciting. And it's not like valuations here are crazy. Okay, the price of sales is close to 2. It's higher than the 5-year average and the sector as a whole, but still not really a huge problem if they can expand on the underlying fundamentals. Well, if the global kind of warmongering continues, yeah, that could happen. They could expand. But look, any inkling of peace talks could see this stock break lower to below 500 in a real hurry. That's just how this works. Now, this is an example of a stock that I'm not in at the time. I'm looking at it because I think it could still be a bit too soon. But based on current levels, let's say I was going to do this trade now, a vertical put spread would kind of be the ticket, where buying the September 520 puts at $8 and selling the 500 puts at $350 could work out nicely. And let's say the stock pulls back to 500, this would be a 3-to-1 reward risk. But it could also be set up as a ratio spread where we buy more puts than we sell. In that case, the reward risk could be quite a bit higher. So these kind of things, how we structure these depends how everything looks when and if I pull the trigger. So it's not set in stone. But like I said, I think it could be too soon. I'll continue watching this one. So to summarize, I believe there is a return to more value-oriented stocks is the current narrative, and I think that's just getting started. Okay, and I do believe we're going to see more of this behavior going forward, probably through the end of the year. Maybe big tech will go sideways, but we'll get a better feel for that in a few days when they report earnings. Anyway, that's all for this episode. Continue to enjoy the summer. See you all soon.